Generally, there are two ways to commit capital to the market. The one, lump sum investing, requires the investor to place all of his assets into the market at a specific point in time. The other, phasing in, requires an investor to commit his capital over a period of time. Ever wondered which one is best? Tonight we attempt to answer this crucial question. On that note, gentlemen, I'll welcome you to the program. Thank you so much for joining us. Zakubi, let's start off with you. If you hit the market at the right point in time, it actually might work in your favor. So let's start off with lump sum investing.
Okay, I think before we get into the semantics of this whole thing, you know, Henry and I sit with a lot of private clients, and we see them going through this thought process of trying to commit capital to a market, and it is quite a difficult thing to do. You know, sitting with a check.
You're trying to time the market all the time.
Well, you know, I think there's a difference between timing the market and phasing capital into a market. You know, timing the market means that you're trying to get the highs and the lows right. You're trying to find those points, those inflection points, where you can sell high and you can buy low. And invariably, if that'll make money for you, you know, the question is that really the most optimal thing to do? I know, Henry, that you've got some thoughts around, you know, kind of timing the market and how successful people are in actually doing that.
Well, I think there's a whole bunch of research we can point towards, but before we even start looking at those numbers, I know great many investors regularly ask themselves, well, you know, should I phase in or shouldn't I? And is it purely a numbers argument? But the reality is, for most of us, it's about much more than that. Sure, you know, part of what we'll be discussing tonight is where do I get my chance to be best off financially? But the other side of the argument is the behavioral side and the emotional impact. Especially if we look at clients that have got vast sums of money. For many of them, the single biggest investment decision they're ever going to make is when they retire and what they're going to do with the capital. And there are a great many behavioral dynamics that start coming into play when you give somebody a pot of money of 5 million rand or 8 million rand and ask them to invest it today. Now suddenly, it's not about where will I make the most possible money. A large part of the argument also becomes, what do I need to do to give myself the best possible chance of not losing it?
Absolutely, because you've got to mitigate the risks and look at the returns as well, Roland. Which would you say of the two is the best option?
Henry's done a lot of research into this, but the are two distinct phases. It's the pre-retirement phase, where the investment strategy is going to be very different to the post-retirement phase. But ultimately, I mean, this is a question to you. If you put a lot of money as early as possible in the market, because markets tend to go up over time, is that not in the long run, the best strategy rather than the phased-in approach? I mean, what is that research showing us?
Roland, the point you touched on is exactly the right one. Firstly, what research does show us is if we look at, you know, the Rand cost averaging argument, if I buy in rising markets and falling markets, on average, I'm going to pay fair market price for whatever it is I'm purchasing is the correct one. And that's absolutely the case pre-retirement. Yeah, so as I'm accumulating my wealth, and all of us do this consciously or unconsciously with our pension funds, you know, for most of us for our largest investments, or otherwise, you know, we keep investing on a regular basis. So by default, we buy in the highs and the lows, and certainly it gives us the best possible chance of negating the short-term impact of market movements. However, the argument becomes different for a lot of people that are on the verge of making capital withdrawals, either to, you know, immigrate, buy a new house, you know, sort of have those large capital expenses, get married, have kids, you know, all of which is happening in my life at the moment. And in the second place, we are going to retire. And now suddenly, you're no longer making ongoing contributions at all. So Rand cost averaging starts falling out the picture. In the second place, what makes the consideration even more trying for most investors is not only do I face a risk of the market going down by 10% over the next 3 months, I'm also going to be drawing an income of, you know, usually anything between 4 and 15% per year. So a risk that investors start running is the double whammy of having a short-term drop in the market, drawing out the income and potentially being in a position that they'll battle to recover
It's interesting, Henry, I'm glad you mentioned with regards to drawing out an income. Some actually are of the view, this philosophy that you should only draw the income with regards to the returns that you get on a yearly basis and then leave the rest of the money where it lies in various asset classes. Is that the right approach to take?
That depends how much money you've got, because
Absolutely.
If the percentage you're getting paid out isn't enough to keep your living standards going, you have to draw down on that capital amount. Is that right?
Absolutely correct. And by the way, we spoke about Rand cost averaging just now, and drawing the income, there's a bit of a reverse Rand cost averaging argument that starts suggesting itself. You know, just as I give myself the best possible chance of not buying at inflated or deflated levels as I invest, as I start drawing an income, a lot of the same thinking starts applying. if I take an income on a monthly basis, on average, I'm going to probably cancel out my losses with more profits that I'll be taking. If I start doing that once a year, let's think about 2008. If I happen to draw my annual income of 10% in November 2008, that potentially can be a financial life-threatening event.
Exactly. That's why you need to make a decision as to whether it is the right time to draw.
Let's do this. There's some research that was done. And as a matter of fact, if you look at your screen right now, you'll see some research that was done by Bill Jones, Professor Bill Jones in the United States. 1953 to 1996, he looked at specifically investing your money for 6 months, 12 months, 24 months, and 36 months. And what he did was he firstly phased money into the market and looked at the return and then compared that relative to a lump sum in the beginning. Now, just have a look there. I'm showing you 2 periods specifically, phasing over 3 years and then phasing over 6 months. Now, what is the total return you gave up? Well, the total return over the 3-year period on average was about 7.4%. Now, I mean, compound that over time, and I mean, you've got a serious return that you're probably giving up by phasing in. Phasing in over 6 months, well, you only gave up about 1.11%. Probably far less because you're obviously getting into the market much quicker. Total number of periods obviously different because the total number of periods that you're measuring is different. Percentage of time at phasing in is greater than lump sum investing. Well, it's only about 26% of the time over 3 years and only about 38% of the time over rolling 6-month periods. And that's some research that was done in the US. Now, what we're going to do a little bit later on in the show is we're going to be taking this methodology and we're going to be approaching the South African market and saying, what are those returns? So, maybe just a question quickly for Henry, just on the just off the bat. I mean, better to lump sum invest than it is to phasing. Certainly, that is what the data shows. How does emotions kind of fit into this?
Well, Bobby, there are 2 main emotions that start coming into play. For most of us, it's loss aversion, and in the second place, a bit of regret bias. But let's look at loss aversion first. It's all going well to see that the numbers would suggest that about 60% of the time, I'm going to be better off by just investing the lump sum, and that's great. So if I were retiring today,
60% of the time.
That's roughly an approximation. The numbers that we looked at in Bill Jones' study, and just now in South African context, we'll see it's pretty similar. So mathematically, I know I should do this. So if that's the case, why doesn't everybody? Well, if you're going to look at the dynamic of loss aversion, it's interesting. There's a psychologist that won the Nobel Prize for Economics in 2002, a guy called Daniel Kahneman. And he did an extensive study on what's called loss aversion. And essentially, one of the things that he proved was that people react twice as emotionally to losing money as they do to making money. By the way, they've tested this on primates and children. Sort of give a child a toy, they're quite happy to get it, try and take it away, what happens? And that hardwiring in our minds never really changes over time. So for us, whether we like it or not, and especially if it's our lifetime wealth in question, a large part of what will be driving our decision is, well, I don't want to lose money, and maybe sacrificing some of my upside is worthwhile if I can give myself a better chance of being okay over time.
So this was being far more conservative as opposed to...
Yeah, but I mean, this was so evident last year. I mean, you look through, from July last year, you'd sit with clients and clients would say to you, I'm about to retire and I know I need to be invested, but putting money into markets that are just, they're losing money, man. And there's a European debt crisis that's busy playing itself out. We're not quite sure where the US is going. And this is where it was at that point where they were starting to raise a debt ceiling as far as the US was concerned. And clients are very, very, very scared. Now, all of a sudden, the research and what the research proves suddenly flies out the window, and suddenly you've got to start dealing with the emotional state. And that becomes, and that's quite a tough thing to do.
Well, the last point I want to add on that is, it means whether we like it or not, most investors will be in a position where when we invest those large lump sums, we have to decide a very simple thing. Are my emotions going to come into play? And for most of us, they will. It doesn't matter, even if you're an actuary or an engineer. In the second place, if they are going to come into play, what is the most sensible way for me to minimize my damage as I go about making this decision? What is the period over which I phase my money in? And what do I stand to lose and what do I stand to gain by making that decision?
Okay, Roland, from a quant perspective, being awfully quiet,
well,
tell us what your thoughts are. I mean, how do you approach this?
Well, two issues I'd like to raise and to answer your question. The first one is that when we analyze market behavior, I understand the emotional side, that's sort of individuals reacting the way they do. But markets have a very strange way in which they operate. They go up slowly over time, and then they have sudden, sharp drops and then they go up slowly again, right? So there's an asymmetry in the market's returns, and surely that will affect to some way the impact of whether you phase it in or the lump sum. Because if you're phasing it in, you're spending more time buying things going up, and every now and then you benefit, obviously, by phasing it in by buying cheaper as the market goes through a bear phase. But the bear markets tend to not, well, in the US and in Japan, there have been 10-year bear markets, right? But generally, we find these sharp, sudden drop-offs. So the dollar cost averaging could cost you more than if markets went as much up as they went down, which they don't do.
Correct. Correct. I think also there's a further consideration for us to bear in mind if we're going to look at the up versus down argument, because part of the point that I'm hearing, Roland, from your side is that if markets are high and there's a greater chance of a drop-off happening, surely that should dictate our decision that we make in terms of phasing in our own money, and we need to consider what the odds are of the market rising or falling in the time that we look at phasing our money in over. Now, what's interesting, if we look at the Bill Jones study that Kobie referred to earlier on, one of the things that he did is, well, firstly, the first finding was that phasing money in over a period of longer than 12 months is almost never worthwhile. The opportunity cost, because the markets will rise on average much more over that period than they'll fall. So the opportunity cost doesn't really make it worthwhile to phase in for longer than 12 months. 6 to 12 months was found to be...
So it washes out over a longer period.
Absolutely, because your money is sitting in cash, whereas had it been invested in the index, even though it is volatile, which by the way is very relevant in South Africa, because as an emerging economy, our index, our equity index is more volatile than most. But the more volatile you get, the bigger the chance that you'll have those short up spikes over the next 6 to 12 months as well. And we'll look at some further considerations around that in a few minutes' time.
On that note, yes, in a few minutes' time, we're going to a very short break. And when we come back, we'll be zoning in further into phasing in versus lump sum investing.